Welcome back. In this episode, we are going to address the question, what is a long-term investment strategy? The most important vision I want you to understand is how to choose long-term investments for long-range goals, short-term investments for short-range goals. When you see how to make the proper choices and to be able to eliminate the dangers that cause most people to lose their money when they're investing for the long run, or they get scared, or they hunker down or put their money in a bank, you cannot let emotion take over, because that's what causes so many people to miss out in the long term. So I'm going to go through some details here on the differences, and you are going to be super empowered by what you hear. I'm Doug Andrew, and I've been a financial strategist for more than 45 years and primarily a retirement planning specialist, helping many people minimize unnecessary taxes and so forth. And so for a long-term strategy, what you want to do is make sure you don't choose a short-term investment. The biggest mistake I saw people make when they would come to me is they were using short-term investments for long-range goals. Sometimes people would come in and I say, well, okay, so let me see where your assets are. And they would have 100,000, 300,000, $1 million sitting in a bank or credit union earning 1%. I'm going, what's this for? Well, I didn't know where else to put it. I had one lady that went, well, I'm thinking about taking a little trip. Really? To the moon? I mean, how much money do you need in a short-term investment? If you park money in a bank or credit union, that might be for a short-range goal, less than 5 years, maybe for a piano or a baby or something like that, or a down payment for a house. When you're talking about any goal 5 years or longer out, that is what I would define as a long-term goal, and it requires a long-term strategy where you don't get all antsy about the market or losing or gaining. We live in a day and age where people wrap their fingers in front of the microwave because it's just taking too long to heat up their sandwich, right? No, we want to see instant growth and we get impatient. And that's one of the biggest reasons why people end up putting money in long-term investments for a short-range goal, like it's a drive-up window at a bank or credit union. Do not mix those up. We want to choose long-term investments for the long-range goals. So let's talk about what some of the best long-term investments are. So many times I will ask audiences when I go out and speak and teach, did you ever play red light, green light when you were a kid? Yep. If you have not, let me explain. You know, you play the game, and it's sort of like a Simon Says, but you turn around at red light, green light, and if they catch you, then you have to take steps back. Well, I had a Series 1 securities license clear back in 1974. And by the year 1980, I ended up with about 3,000 clients over 13 Western states. And I was trying to do my darndest to, in a long-term strategy, have their money diversified into a portfolio of some of the top mutual funds. And we were doing a pretty good job at trying to average 12%, which is 12 steps, see? And so what happens is many times money in the market, you take 20 steps forward, a 20% increase, but the next year you take 10 steps back. And then you go forward and back, and you're back and forth. And so we were trying to average 12%. Well, we realized that that wasn't maybe the best long-term strategy, because people would get heartburn about the market when it dropped. And I would have to go to the office and field phone calls. And I thought, you know what? There's got to be a better strategy that helps people sleep at night, especially when the market takes a nosedive. And I found it. It's called indexing. And I'm going to share with you the results of what that does, because you don't lose when the market goes down. And those 3,000 clients were never happier than when I got them out of the market, but just simply linked their returns to the market, to an index. An index is just a measuring tape. sort of like the Dow Jones or the S&P, Standard & Poor's 500 or the Russell 2000. Those just measure the top 30 or 500 or how many different corporations they're measuring. And if they're up or down, that's an indicator. But see, there are institutions that will link your return to an index, but your money is not at risk in the market in that index. And that's called indexing. Some financial advisors think they understand this, but they don't, and I can sort of stump them in less than 60 seconds. What we want is to have a strategy that is for long term, but you don't get heartburn when the market goes down, because it's a fact of life. The market will be down 30% of the years in a 10-year period. 3 years will probably be down. The other 7 years will be up. Just make money on the up years and don't lose money on the down years. It is amazing how many advisors never are trained how to do this, unfortunately, because sometimes I think the broker-dealers are saying, oh, no, just tell your client, just hang in there, hang in there. Well, that frustrated a lot of people in the years 2000 to 2010 when they had to put off retirement 7 years in the year 2000 because they lost 40% and it took 4 years just to come back. And then they were going to retire in 2007 or 8 and it took another 40% hit and it took 4 more years before they could feel like they could retire. So they felt like they lost their future. So let me share with you just a little snippet about how indexing helped people to triple their money in that time period instead of sitting there and just barely being back to break even. So indexing could be compared to a ratchet wrench. If you've ever had a ratchet wrench where you were tightening a bolt, the way it works is it goes click, 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 and it tightens it. But see, when you reset, when you come backwards, it doesn't loosen the bolt. And so with a ratchet, you only tighten. You tighten and then click, 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 and then tighten. That's what indexing does. It's called lock in and reset. So for example, if in a given year the market is up, I get whatever that index does up to a cap. Now, the insurance institution where I link my returns to an index, they don't actually have my money invested in the market. Let's say I chose the S&P 500. And if the S&P 500 was, let's say, 1,000 at the beginning of the period that I was linking, it could be a calendar year or 1 year point to point, October 3rd to October 3rd of the next year, they measure the change in the index that you choose. Now, I diversify into many different indices, but let me simplify. So if the S&P went up from 1,000 to 1,100, that's a 10% increase. The insurance institution then must pay me 10% on my money. If I had $1 million in there in the year 2000, they would owe me $100,000. Now, how can they afford to do that? Because my money's not in the market. I simply allow them to take the interest on my money. See, I can choose to let my money just sit in the insurance institution and earn 4 or 5%. That's called their general account portfolio rate. But if that were 5%, like it was in 2000, that's $50,000 of interest on $1 million. I can just settle for that, but if I feel, bullish about America, I can say take the interest, the $50,000, and use that in any way you see fit to be able to afford to pay me whatever index I choose based upon what they offer. Well, this is a no-brainer for them. So they have $50,000, so they buy upside options in the S&P 500, which means if the S&P goes up 10%, they have $100,000 to pay me. But what if the market loses? I relinquished the interest on my $1 million, but I didn't lose the $1 million. See, people that had their money in the S&P, they saw their $1 million go down to $600,000 by the year 2003. If I had indexing and I had linked every year, I would be at break even just $1 million, but everybody else had to wait 4 more years to come back to break even. I start making money again as soon as the market turns around. But in another episode, I talk about, I only earned 0 in the year 2001. 2002 and 2003, I just said, oh, pay me the 5% until everybody stops rubbernecking on the economic freeway and the market turns around. And when it turned around, it came up and I was able to earn up to a cap, because the insurance company has to put a cap because they can only buy so many options with the interest on my million, because they don't have my full million to work with. So by doing that, what happened? From 2000 to 2007, many people following what I am teaching you doubled their money. $1 million went to $2 million. Other people in America that had their money in the market, they were still down and barely back to break even. In the next 7 years, 2008, they lost 40% again. We didn't lose. And by the end of 2010, we had tripled our money. By 2015, we had quadrupled our money. What would you rather have? At the end of 2012, 3 million or 1 million? Would you rather have the heartburn of going up and down in the market, or just have the nice assurance that when the market goes up, you get to participate? When the market goes down, you don't make anything, but you don't lose. So the key idea here, in order to choose the best long-term investment strategy, is choose long-term investments for long-range goals. I prefer the investment vehicle that will generate the most at the time in life you're going to be using or needing the money the most. Most people think, well, you choose the investment that grows to the most. Nope. I want to choose the one that will generate the most after taxes, inflation, market volatility are taken into consideration. So my favorite vehicle I call the laser fund for that very purpose, because it has all the key elements of a prudent investment. But by using indexing, I don't lose when the market goes down, and I make money when it goes up. I have averaged about 11.17%. It runs about 1% to pay not tax. 1% is the cost of the insurance that the IRS says has to be there in order for it to be tax-free. So I would rather earn 11 and net 10. I'd rather play red light, green light by going 11 steps forward and 1 step back to net 10%. Some years I earn 7 to net 6. Some years I earn 25 to net 24. But I've averaged earning at least 10, netting 9, some years 9, netting 8. And that net is tax-free, which is way better than having my money in the market, where the analysts like Dalbar say that the average mutual fund stock market investor only earns about 3.5%. That's pretty pathetic. Eliminate the losses in the first place. If this resonates with you and you want to learn a little bit more about this and how to solve it, I would recommend watching this episode and then perhaps getting a free copy of my latest book.